Hi guys, I am Shane Galea, your leading property development expert for your property development needs. In today's My Development podcast, we would like to give thanks to Australia and New Zealand Banking Group Limited for sharing with us their market research report dated May 2, 2022. Residential. Starting to see some greater divergence across the country now as higher interest rates become a reality. Keep in mind that although the RBA hasn't increased the cash rate just yet, is tomorrow the day, fixed rates actually reached their lowest levels about 12 months ago and have been climbing since then. As I noted in the last update, the effect of still low rates hadn't fully played through, and that's still the case across markets in Brisbane and Adelaide, prices up 6% in the last quarter, Canberra 3% and Perth 1%. On the other hand, prices have started rolling over in Sydney and Melbourne, with values down 1% over the last quarter in both cities. I think this difference is mostly due to the much higher price point and higher debt levels in Sydney and Melbourne compared to the rest of the country, which makes them more sensitive to higher interest rates. That is exactly what we saw during the last downturn in 2017-18, where prices started to fall earlier and ultimately more sharply in Sydney and Melbourne. Moving forward, the main story is going to be around interest rates and how quickly they will affect people's borrowing capacity. ANZ research is forecasting that Sydney and Melbourne will again experience a faster and larger drop, although the expected adjustment is still smaller than the scale of the price increases since COVID arrived. The other states and territories are likely to see further price growth over the near term, although it is only a matter of time before higher interest rates begin to bite and put downward pressure on prices. Offices. Still a huge divergence between valuations, which continue to push up to new record levels, and vacancy rates, rents which are soft. According to PCA data, office usage compared to pre-COVID is improving each month, but is still very low. Melbourne is lagging behind at 32% occupancy, via Sydney, Brisbane, Perth and Canberra 40 to 50%, while Adelaide is out in front at 61%. These numbers are consistent with ANZ spending data, which show the number of CBD cafe transactions is down around 40% across each of Sydney, Melbourne and Brisbane. A lot of that weakness in office attendance in recent months was still due to COVID mask mandates and density requirements. More structurally, office vacancy rates are generally improving as well, but only very slowly. Most capital cities have seen vacancies fall over the last year or so, but only Adelaide has recovered to its pre-COVID levels. Canberra is still the exception, with the vacancy rate improving throughout COVID and is sitting at the lowest level in a decade. As we've been seeing for the past 2 years, face rents are holding up well, but requiring ongoing increases in incentives to do so. Incentives nudged higher in Q1 and remain at very high levels across Sydney, 47% vs 30% pre-COVID, Melbourne, 44% vs 34%, Brisbane, 60% vs 55%, Adelaide, 59% vs 54%, and Perth, 57% vs 55%. Canberra is faring better, with incentives only 34% vs 31% pre-COVID. Nationwide, this means that face rents are up 3% over the last 2 years, but net rents are actually down 16%. At the last update 6 months ago, I noted that capital values had started to stabilize, but they've since picked up again as yields have tightened even further. Even secondary stock is now getting sub 5% in Sydney and Melbourne. It's increasingly hard to see this continuing for much longer, given higher interest rates is a matter of when, not if, and it's looking like being an extended rate hiking cycle. Industrial. Still red hot. One way I like thinking about this segment is the rising penetration of online retailing. ANZ data show that today about 20% of all retail spending is now online, which is an increase of about 50% since COVID and nearly double the level of 2018. That's a massive shift in just a few years, and with clear consequences in terms of traditional bricks and mortar retail stores versus industrial storage, warehousing, logistics requirements. I mentioned last time that this tangible business demand was driving rental increases, and this has accelerated over the past 6 months. All capital cities, EXCL Perth, saw rents increase by 3% plus in Q1 alone. Yields have continued to fall as a lot of money flows into the sector and are now around the mid-3% range across Sydney and Melbourne. Slightly higher across other cities, but still down sharply from pre-COVID, Brisbane 4.3% average yield, Perth 4.6%, Adelaide 5.2%. The chart below shows the increase in rents and capital values over the 2 years since COVID arrived. Rental growth in industrial properties is a stark difference to falling net rents for offices and the flat to negative movements in retail rents. Coupled with the sector becoming fundamentally more attractive to investors and yields tightening, the implied capital valuations have been incredible. As I noted last time, the contraction in yields will shortly stop as rates begin to rise, but the sector is well positioned as rental growth will provide some valuable insulation. Retail continues to be really mixed across the types and locations of retail assets, as you would expect given the themes I've mentioned above around fewer people in the CBD and more retail spending being conducted online. Neighbourhood centres and bulky goods or large format retail are the relative outperformers, with rents essentially flat over the last 2 years and up slightly in SE Queensland. CBD retail is still the most impacted segment. Rents are down materially across the country, from 8% in Adelaide and Perth to -23% in Melbourne and Brisbane and -33% in Sydney. Vacancy rates, data only to December instead of March, tell a similar story and sit between 11 to 17% across the country. Probably not unexpected given the lower number of people and volume of spending in CBD as I noted above. This email and any attachments to it, the communication is, unless otherwise stated, confidential, may contain copyright material and is for the use only of the intended recipient. If you receive the communication in error, please notify the sender immediately by return email, delete the communication and the return email, and do not read, copy, retransmit or otherwise deal with it. Any views expressed in the communication are those of the individual sender only, unless expressly stated to be those of Australia and New Zealand Banking Group Limited ABN 11,005,357,522, or any of its related entities including ANZ Bank New Zealand Limited, together, ANZ. ANZ does not accept liability in connection with the integrity of or errors in the communication, computer virus, data corruption, interference or delay arising from or in respect of the communication. Thanks for listening to the My Development podcast brought to you by Shane Galea, your property expert guide for your property needs.